Hello, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, October 9th, and you're tuned into On Trend, the show designed to keep you on the right side of the trend. So today we're going to make the case for a mixed up market. It's with the performance differentials. We're going to look at the energy-related ETFs that are holding their breakouts. We're going to show you a major breakout in nat gas futures and show you how to analyze commodity futures. We'll look at gold and the Bollinger Band head fakes. And finally, we'll show you that insurance is leading the finance sector. The case for a mixed up market. So we've seen a split in market performance widen actually over the last few weeks. There's always been, some leaders and some laggards out there, but, for the most part, we've had more leaders than laggards, and that has caused a broad uptrend in the broader index ETFs like SPY, MDY, and IJR. Now you can see that SPY hit a new high there in mid-September, and QQQ actually edged to a new high in October. So they're the clear leaders, but we can see that QQQ did not hold that wedge breakout and fell rather sharply. Now, is this a big trend reversal? No, I can't call it a big trend reversal yet, because you can see on all these charts that these ETFs were up substantially from April until September. And even if they give back, say, 1/3 to 2/3, SPY could conceivably go back to the 280 level on a normal correction. And QQQ could go back to the, 170, 175 level on a normal correction. Now, if we look at MDY and IJR, they peaked in late August and they started this decline, and they've already retraced 38 to 50% of this advance from April until August. So they are leading the way lower. I don't take them as the canary in the coal mine, so to speak, because I've seen too many times when, mid caps and small caps go through a lagging period only to play catch up a little bit later. So at this point, I still think it's a normal correction. But the fact that we've got this split and this splits that has been widening leads me to believe we could be in for some choppy trading in the coming weeks. It could even last a couple of months. Now, there are pockets of strength still in the market, but we'll look at some of the pockets of weakness, and these pockets of weakness will definitely weigh on the market. We got the communications sector, SPDR, and you can see that, it peaked there in July, had a lower high in August, a lower high there in September, and then it broke down in the first week of October. So it, barely moved below that September low, but it is clearly one of the weaker groups right now weighing on the market, and that is 10% of the S&P 500. And then we get to housing. Housing has been weak the entire year. All right, you had this descending triangle continuation pattern and a breakdown. Now, keep in mind, I'm not necessarily making the case for a bear market, all right, because in the next part, I'll show the pockets of strength. And keep in mind that the market is a mix of sectors and industry groups and stocks. And until you get 60% of these going down, you can still have a flat market. It's only when the majority are going down. Now, sure, some key groups are weak, but as I'll show next, some key groups are also strong. But one of the weaker technology ETFs would be the First Trust Internet ETF, because it had a lower high there from July to August, and then it broke below these summer lows. So we have a lower low, and basically we have a downtrend. And you say, well, RSI is oversold. Well, I would ignore this oversold reading because this ETF is showing relative weakness within technology, and it broke those lows, and it looks like it has reversed its uptrend. So there are other setups that I think are better out there. Another cause for concern is the breakdown in semiconductors, all right? We can see a 52-week high there, and then a break below these summer lows. And the SOX has been underperforming the entire year. It's got lower highs working. But this is a broader semiconductor ETF, XSD, and the break below the summer lows is a negative. Now, before you get too bearish, you got to take these support breaks with a grain of salt for these broad market ETFs, because, you go back here to February and we had, a big support break there. And what happened after that support break? we surged to a 52-week high. So, this ETF is very prone to very choppy uptrends. All right. So, RSI is below 30 and it could be still a choppy uptrend. I'm sure if you put a 50, 200-day EMA on this, the 50-day EMA would be above the 200-day. But, look at this selling pressure that we've had. So semiconductors are probably a place not to be looking right now. There are other setups that are better. Then we look at software. That's a stronger one. I didn't want to show that one. I want to show broker and dealer iShares because it broke below this low here. Now, maybe it's a bear trap, but, it's been trending lower for most of the year since March there with a lower high in May, June, and then again in the summer, and then a lower low here. So you got this bounce here, and so maybe that's an oversold bounce. But yeah, it's not the best looking chart out there, so I would wait until something better materializes. Regional banks, also an interesting setup here. I'm going to do more on finance, but they've been going nowhere, all right, the entire year, and they're in the bottom half of their range, so they are weighing on the market right now. And then metals and mining weighing on the market. Now, what's interesting is these weighing ETFs and groups that are weighing on the market did perk up a little bit recently. So, but if you look at the trend here for XME, it's clearly down. The material sector does not look like a strong sector at all right now. So, yeah, maybe there's an uptrend here, but it's within a bigger downtrend. So these are weighing on the market. Now, those pockets of weakness that I've just showed you are offset by some pockets of strength. I mean, look at industrials, all right? They've just traded sideways over the past 2 weeks, and a pennant has formed. So, had this flag breakout and the move to new highs, and then this pennant. Now, I admittedly have not had too much luck with pennant and flag breakouts after big runs like this. It's usually the pennant or flag that forms after the first advance that's the best, and this is the second advance. But still, it's holding up, and unless this breaks below 78, we don't have even a correction on our hands yet in XLI, so it is still holding up. We look at XLE, all right, still 6% of the market, and it is holding up of the S&P 500, all right, holding above this breakout there. So XLE remains strong. Healthcare, it pulled back last week, but overall it remains one of the strongest sectors, from 79 to 96 over this 5-month period here. So those are 3 pockets of strength. Consumer staples are also fairly strong. All right, we can see this uptrend is still holding with this bounce off support that we had yesterday. And then we look at utilities getting a big bounce over the last 2 weeks with that move from 51.5 to 54 and change, keeping this uptrend alive. And these sectors that I just showed you account for 33% of the S&P 500. So they are keeping the market afloat right now. And, XLY and XLK have pulled back, but they're still in uptrends as well. And I haven't even counted them. Energy-related ETFs are holding their breakouts. So XLE remains strong. It hit that 52-week high in May and then kind of had this zigzaggy correction, bounced off that 71, 72 area twice, and had the breakout here. Now, it could still have a throwback or a pullback after this big move up, but I think this is a bullish breakout. It signals a continuation of this advance, and I would expect new highs out of energy in the coming weeks. Now, diving down into the sector and looking at some of the industry group ETFs, we've got XES. And this one is just all over the place. I mean, it had this huge decline into 2017 and then tested support there in April 2018 and had a big advance, but a deep decline, but ultimately formed a higher low. All right, so that higher low is positive. You didn't get down to that low, you didn't break it, you formed a higher low, and we broke out here to form a higher high. So it looks like XES is turning the corner here. We'll look at XOP, and it is stronger than XES. And you can see that the pullback that we had here was a lot less deep, if you will. You know, we didn't come back down to those April lows at all. It just held above that 50% retracement and got the breakout there. So XLP is one of the stronger industry group ETFs right now. And then we look at FRAC. I mean, this kind of tells you that things are perking up in the industry. I know this is still, you know, too low the volume levels are too low for trading, but you can see there, you know, you got that wedge breakout there, and it is moving higher. Now, what's interesting is, you know, FRAC has Occidental Petroleum in there at 8.3%. So I don't know how unconventional Occidental Petroleum is. And finally, we have one with a setup brewing. That would be the Alerian MLP ETN, AMJ, because you can see you got the big surge, a little wedge pullback, and a wedge breakout. And now we've had a bit of a pullback here, but it's still, I think, a correction within a bigger uptrend. And we're stalling right below that breakout zone look for a breakout there to reverse this correction and signal a continuation higher. Now notice that RSI gave us the early signal as RSI moved below 30 and then back above 30. So it was oversold, and now it has relieved that oversold condition with a bounce that signals there's a possible upturn in momentum. Now, one thing about AMJ and XLU utilities and REITs is dividends do count, all right, on this chart. You can see I've just got the AMJ symbol at the top upper left there. So this includes the dividend adjustments. The next chart does not include the dividend adjustments. So if you see here, we got back to that 2018 high here in August with dividends. But if you strip out the dividends, we didn't get back to that high. And so I'm sure you're wondering which chart is right. Well, frankly speaking, dividends are an important part when you're investing or trading in something like AMJ or XLU. I think you're counting on that dividend because you know it's pretty hefty. So I think the total return picture is important. But I think as far as a 52-week high, you probably want to use unadjusted prices. All right. So when we look at this chart here, it's less bullish than the other one. All right. You still have got the wedge here, and you've got the wedge breakout, and we've got this channel that looks a little bit different, but the resistance level is the same. The short term doesn't change that much. We still need to get a breakout at 28.5 to reverse this slide that we've had here over the last month or so. And by the way, if you want to see a chart without the dividends, you just put an underscore before the symbol. As you see, I have underscore AMJ, and that strips out the dividends. A major breakout in natural gas futures, and we'll also show you how to analyze commodities here on stock charts. Now, before we look at the breakout in natural gas, I just want to show you two charts to compare the natural gas ETF UNG with the continuous futures for natural gas, dollar nat gas. All right, and this is to show you that you should not use UNG for long-term analysis, and you should even be careful with UNG for short-term analysis as far as I'm concerned. If you really want to analyze these commodities like oil and natural gas and gasoline, which I'm going to show you now, you need to look at the futures prices. And we do have those, and I'm going to show you how to get them. But if you look at this natural gas contract, you can see, the natural gas ETF, you can see that lower low, all right? Whereas natural gas continuous contract formed a higher low. And that's because with these ETFs, you've got rollovers, all right? You've got management fees and contangos and backwardations and all that stuff working that has to be managed, and that affects the return of the ETF. And you can see here, whereas you're 29% below this 2017 high still, now you're only 16% below that high when you look at the continuous futures contract. So the bottom line is definitely for long-term analysis, throw out a UNG. You can't use it for long-term analysis. You can't even use it for long-term investing. All right, it's a short-term trading vehicle, couple weeks, maybe a month. all right, but it starts to lose it doesn't perform in line with the underlying contract, so to speak. Now, as far as analyzing natural gas, I think there are two ways. First, you have the continuous futures contract, all right, and that is dollar nat gas here. And it's really best used for long-term charts, and because it's a bunch of futures contracts that have been stitched together, all right. But what we can see here is we can see a clear break above these highs here and a higher low here in the summer. You held above that December, February low there with these lows in July and the triangle breakout, and that's a multi-month high. And then you can see the PPO. The 50-day EMA is the furthest above its 200-day EMA than it's been in a year. But if you want to take it even one step further, you can analyze the current month contract, all right? And this would be the November 2018 futures contract for natural gas. And you see the symbol is a caret, NG, X for December, 18 for 2018. And I'm going to show you how to find those symbols here in a minute. But if you look at this contract, you can see that it was not above 310 the entire year until this breakout in September. So this is a major breakout in natural gas. And I'm not going to go into the fundamentals because there are too many fundamental issues for me to decipher and weigh them and decide which are more important and how they're going to play out in the future. All I can do is really look at the chart. And this is clearly a major breakout in natural gas. So it's something we should have on our radar. Now, the reason I put volume down here is because when you're looking at these futures contracts, you want to be focused on the most active futures contract. So you can see, the activity started to grow slowly, and then it really moved up exponentially because the other months were expiring, and this became the most active contract, and that's where all the action is, so to speak. And I'm not going to get into backwardation and contango. You can do that if you want. But what I see here is a breakout in natural gas, and so I want natural gas on my radar. All right, so where can I find symbols for these commodity futures contracts? Well, here I am on the free charts page, and if you go up to the corner, there you can see the magnifying glass there. And if you click on that, you can search, and you just have to search for one little keystroke, a caret. All right, and I don't mean the carrot you eat, it's a caret. All right, so you get your support articles. We're not interested in those. And if you go down, you click symbols, it'll show you all the symbols that begin with that caret. All right, and these are all going to be the commodities that we carry, the commodities futures contracts. All right, and then you can see the name, the month, and the year, and they're all end of day, and the exchange. But we have, Brent crude, December 2018. We got soybeans going to 2019, wheat, corn, Brent. And if you scroll further down that list, you're going to find other things like cocoa, light crude, and eventually gasoline, silver, the dollar, coffee. So there's a lot to work with there. And this is what the ETFs are based on. This is like going right to the source. All right. This is the purest form of trading that you can find for these commodities, basically, is right from the commodity futures pit. So if you're interested in commodities, you need to be looking at these. So now we're going to look at gasoline and oil, and we'll look at the continuous futures contract first. And you can see there was a new high in May and then a pullback, and it is turning up and breaking out. All right, but this is a long-term chart. It looks different than the November 2018 futures contract, which I think is probably a more robust chart because you got this correction as well. You got the breakout, and that's a new high. All right, so gasoline is moving higher in price, and that is maybe bullish for some of the gasoline-related stocks. And then when we look at the ETF, it's not too bad at tracking here because you can see it's got that breakout there and a new high. So gasoline is strong. And next up is West Texas Intermediate Crude. Now there you can see we have the continuous futures contract first. And, it's clearly in a long-term uptrend. You had a stall here in February, March, and a breakout. You had a couple of pullbacks along the way and breakouts, and that's a new high. So a clear uptrend there. And then we look at the November 2018 light crude contract. We can see the breakout there and the move to new highs. And then when we look at USO, we can see a breakout there in August and a move to new highs. But keep in mind, USO, UNG, GAZO, they need to be used for short-term trading. They're not long-term vehicles. All right, now I'm going to show you some stocks that are related to natural gas in some way, shape, or form. If you need to know more about them, I suggest you go to Zacks or IBD or somewhere to find out exactly what they do. But this first one is EQT, and it's one of the biggest, if not the biggest, natural gas producer in the U.S. And you can see that it is nowhere near a breakout, and it is in a long-term downtrend. So just because natural gas is breaking out doesn't mean everything is going to go up that's related to natural gas. You still got to look at the price chart. All right. Maybe there's a massive double bottom forming here, but this is one of the weaker natural gas plays because it's clearly in a downtrend. So you still have to be selective within this area. Now, one that looks stronger is LNG. Now, they're not a producer, I don't think. I think they're liquid natural gas is what they're doing here. But, this stock is in an uptrend, all right? Consolidation, breakout, pullback, breakout. It's got a little throwback to this breakout zone, this support zone. So this would be more preferable over EQT just because it's already in an uptrend. And then we have DCP, which I would imagine is some sort of a pipeline. And we can see that it's also in an uptrend overall. Some fairly deep pullbacks along the way here, but bouncing and getting a breakout there over the past week or so. And you can see RSI moving back above 30 from oversold. So this one's looking positive. We have another LP here, and that would be HMLP. And we can see that this is a breakout to a 52-week high. And we had a pullback after this breakout, and now looking for another breakout there to end the pullback and signal a continuation higher. Now we get into more of the exploration and production side of natural gas. All right, this is Southwest Energy, and I looked through a lot of these stocks, and I normally don't like to even look at low-price stocks because they carry above-average risk. All right, but this has one of the more bullish-looking charts here, Southwest Energy, as far as the group is concerned, because you had a pretty big advance, a big consolidation, and now it looks like we're on the verge of breaking out of that consolidation to continue higher. But you can see, if you're buying around 5.8 and you got a stop loss around 4.7, 4.6, that's a 20% risk there. It's a pretty high risk play. Comstock Resources, another natural gas play, stronger because, it hit new highs there in May, July there, pulled back and is on the verge of breaking out here. But again, it's a low price stock, so be careful. You can see it's bouncing off that retracement zone as well. So it's like 2 steps forward, 1 step back, and trying to make that second step forward. Chesapeake, they've been through all kinds of issues. If you read about the fundamentals on these stocks, you'll probably just get bogged down in a huge quagmire. But Chesapeake did break out there. All right, it broke a resistance level in May. The 50-day EMA is above the 200-day EMA. You had this big move up. You have a pullback with a wedge, corrective, and now you're breaking out of that wedge. So Chesapeake looks like it wants to make up for some downside that it had before. And as always, keep in mind, if you have any questions, comments, or feedback, you can always send an email to askarthur@stockcharts.com. I cannot answer all of them, but I promise to read and consider. Gold and the Bollinger Band head fakes. Before looking at the Bollinger Band setups, let's look at gold continuous futures versus the gold ETF. And with these hard assets like gold or copper or silver, they tend to track their ETF, or the ETF tends to track the underlying security much better. And if you look here at gold continuous futures, it was up 10% here, and so was the gold ETF. And then the gold ETF fell around 14%, and this one fell 14.9%, so 14.3% to be exact. But these things track each other pretty good. You can see the 200-day EMA there, the same as far as the crosses are concerned. So you can use GLD as well as the gold futures or the continuous contract when it comes to this ETF or this hard commodity. All right, now let's look at the Bollinger Band head fakes that we've had over the past year. I've got three indicators here. Bollinger Bands on the top. I've got %B in the lower window there. So when it moves above 1, that's a move above the upper Bollinger Band. When it moves below 0, that's a move below the lower Bollinger Band. And then I've got bandwidth, and that's basically shows you when the bands are narrowing. So we had a narrowing in November 2017, and then we had a breakout to the upside. But it turned out to be a head fake because it didn't last, and you immediately moved down. All right, then we had another squeeze going into March and an upside breakout. But that one lasted a little bit longer, but it didn't work out because you moved down in April. In June, we had another squeeze when bandwidth contracted and moved below 2%. And then we had a breakdown, and that turned out to be a great signal. You caught a move from 122 to 112. And that brings us to the current situation. All right, we have a Bollinger Band contraction, which tells us that volatility is contracted. We had a signal with a break to the downside. We've already bounced back up, but we haven't moved back above the upper band. But if we move back above the upper band, that would make this a head fake, and that could be a bullish signal for gold and suggest that gold is going to at least get a counter trend bounce. Insurance is leading the finance sector. So I'll start with a chart showing treasury yields. We've got all of the treasury yields on the top window, and you can see the 3-month treasury yield and the 2-year treasury yield have been moving higher all year long. And then the 30-year was flat for a little bit, but longer yields moved sharply higher over the past week or so. So treasury yields are definitely moving up. But what's also interesting is the yield curve appears to be turning up and widening again. And that could be a positive for banks. But again, keep an eye on those charts because KRE and IAI, the regional banks and the brokers, don't look that positive. XLF looks better. You can see this support zone here that it is holding with 3 bounces, that little gap last week. So this is bullish as long as it holds. But if you close below 27.4, all bullish bets are off. But the leader is clearly insurance because KIE hit a 52-week high in late September, fell back and bounced again. So it seems that the insurance companies like what's happening in the treasury bond market. And quickly looking at 2 banks, JP Morgan's holding up better than a lot of banks in the group. They break out and they're holding support and trying to bounce off support. So a move below 111 or so, and that is a failed breakout there. And then Bank of America is still correcting, and it needs to break out at 31.5 to reverse its slide. All right, so that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend. Have a great day.